Hey everyone, hope we're doing well. Welcome back to the LAGFX channel. Today on the Learn to Trade series, I just wanted to walk through a little concept and an analogy I came up with when I was in a call with a client and pretty much was trying to help them understand and explain why supply and demand zones introduce supply or demand into the market. Now, the reason why they do that, how we identify them correctly, and why they pretty much are one of the main tools within my strategy. So let's say we are within a bullish market. So we have uptrending structure. What that means is that the highs are being broken and the lows are being protected. Now, we look inside of that structure. Let's just make that black. We look inside of that structure. The first thing we can do, so let's say we're looking at this and we see that the market is starting to round off. We come down, we displace right there. So we have the displacement. So this is our bullish impulsive wave higher. We've had the displacement, so we're more than likely now going to have our bearish correctional wave, which will have the purpose of protecting the overall low of the overall structure, but also coming back down to introduce enough demand to cause the next impulsive wave higher. So the first step that I like to take when it comes to this is to identify all the swing high and swing low points. So if we just draw a little circle around each one of these, because these are going to be relevant within the analogy and within my explanation of this concept. Okay, so at every single swing high or swing low point, that is a point in the market where the institutions have executed an order. So on all of these swing highs in the market, the institutions have executed sell positions right at that peak, right at the top point. All of the swing lows within this point, that is where the institutions have executed large buy positions right at that point. Now, order mitigation is where price trades us back down and taps that level. So if we were to actually just draw, we'll just keep drawing rays on all of the highs. We can actually lock, if we do that. Okay, so we'll use these rays just to draw every single high in the market. And now, every time, so this is obviously an impulse correction. Every time the correction comes to tap or surpasses this level, we know that it's been mitigated. So what we'll do now is we'll actually change color of this to an orange, let's say. So this one has been mitigated. And that move lower comes to mitigate that point. The fact that it touches or goes lower than this level means that that's been mitigated. We go up, nothing surpasses that. That zone isn't mitigated. And then here, this gets mitigated out. So looking inside of here, all of these points are areas where the institutions have sell positions activated. Of course, this one has already been mitigated. We've come back through. If we drew the line there, we know that price has already come back through. So we have these two zones. Now let's just draw those together. So we have two sell positions, arguably still active within this move. But on the flip side, we have all of these buy positions that are currently still active. So that's 4 there. This one has been mitigated because price has come lower, which therefore tells us they have taken that position off so that they're not running in a minus. However, now that we have reversed the market, we have a position here. So as of this point, looking at where price is right now, let's just say that every single open position is one lot. So as of right now, that's obviously another sell position. We have 2 lots of sells there and 1 lot of sell. Here we have 4 lots of buys. So the reason this market was bullish for as long as it was is because we had more lots on the buying side than we did on the selling side. Now, to confuse this even more, yes, I've written 4 there, but it's typical that in a bullish trend, the buys that are executed are probably going to be much larger than the sells. So let's just say that each one of these is 2 lots. So we actually have 8 here. Now what's going to happen is we've come up, of course, these are the ones that have been mitigated. Let's just get rid of those horizontal rays now that we actually know which ones have been mitigated and which haven't. Now, looking into this, we would identify the two sell regions that price hasn't actually mitigated, which would be the two of those zones right there. Now, the reason why, before we go any further, demand zones are valid is because when price taps us into this, we instantly remove one lot of selling pressure, and therefore where we have 8 against 2, it then becomes 8 against 1. So demand is introduced to the market because there is now so much more buying pressure compared to selling pressure, and therefore what happens is we bring price down, we take off some of the selling pressure, which is instantly going to jolt the market back up. And then, for example, if we were to reverse in this one, and let's say price trades us back down, just change that to black so we understand what's happening. Price trades us back down, we accumulate, and what's happening inside of the accumulation is we've mitigated one lot on this side, and we've also introduced another lot of buying power because we know that in the spring of an accumulation, we have a buy position executed. So pretty much what's happening in the process of us tapping a demand zone, accumulating and reversing, is that we have taken supply, so selling pressure supply, out of the market, tilted the supply and demand balance more into demand's favor, and then also introduced more demand because we have executed a position at this point here. Now, the reason why I said if we were to tap in this zone is because if you think about this, if we were to tap this and continue higher, we're then leaving this zone unmitigated, and we're carrying on higher while still having this one lot down here, which is going to create some pressure to the downside. So if you've got two zones like this and we are 100% sure that both of them are correct, both of them are definitely unmitigated, I'd always go for the lower of the two demand zones, because in that point, we're taking off this sell position and also this sell position. Now, when we get down to this level, we are much more into demand's favor within the supply and demand balance. And again, when we tap this, we take off lots to the selling side, and therefore demand is introduced. Now, to take this further, you are quite right in saying that in this move down, each of these levels now act as lots on the selling side, which is why when we do eventually accumulate, and this is why Wyckoff is very important, in the accumulation, we have to open such a large buy position, because as of right now, the odds are stacked against us because we have so many sell positions going, but unfortunately, we only have this buy position, just looking inside of this region. So what's going to happen is, let's say each of these is one lot of selling pressure. In this accumulation, we're going to have to introduce more than those 3 lots of selling pressure that's currently in the market in order to make the move happen and make price go higher. That is why looking for Wyckoff entry is so important, is because that is exactly where the major positions are being executed by the institution. So if we can get involved right at the start of when those positions are being executed, it gives us the opportunity to profit massively. Also, the reason why what typically happens in a market is we range for a while, so we are accumulating, and then the second we break out of that range, we're going to have so much volatility to the upside, because as stated, they've introduced that much demand from that buy position that price just has to shoot up in that way. So I hope that makes sense. I know it's quite a hard topic to fully grasp and understand, but it's a good way of understanding why supply and demand zones are valid, why they do what they do. It's all about taking supply out the market, introducing demand, taking sell positions off, introducing buy positions. Now, this is happening constantly, because if you understand the fractal nature of the markets, we understand that this could be happening on the 1 second, inside of 5-second structure, inside of 1 minute structure, inside of 15-minute structure, blah, blah, blah. And this is constantly compounding again and again on top of each other. So as we look inside of this now, if we look at the main positions, overall, this buy position is still running and this buy position is still running. This sell position has been taken out. So as of right now, we are profiting on these 2 buy positions, and they are the only 2 positions in the market as of right now that are relevant. Now, the reason why protected lows are so relevant is because the second that we have that displacement, we have shown signs now that we want to start introducing supply and profiting from these sell positions we've got. So taking a liquidity low means that we are closing out on a buy position, which means that we are taking away from demand and introducing supply, which is why displacement is very, very relevant for a market reversal. Anyway, sort of just waffled on there about that topic. I hope you could understand that. It was sort of just an analogy I came up with, and it made sense in my head. I'm hoping it makes sense to people who aren't quite as knowledgeable on this subject as myself. So if it was helpful and you did understand what I was getting at in this video, then please let me know in the comments. Right, so I literally just filmed this and realized the mic wasn't even plugged in, so take two. Basically take everything I've said in this video with a pinch of salt, so to say, because this is like a very base level of understanding of the concept, and there's so many more advanced things that tie into the overall concept which are going to completely change how it all works. But that's just like the base understanding of how order mitigation works, how the supply and demand balance determines price direction, and why supply and demand zones are very relevant within the strategy. So just understanding order flow and order mitigation within the smart money concept strategy is crucial, and I hope that helped give a bit of background as to why it is crucial, because we're taking off and introducing orders all the time, and of course when the institutions execute orders, they're putting on that many lots. Obviously the example I was using was one lot, but we're looking at them putting on hundreds of lots per execution. So, you know, hundreds of millions, if not billions of dollars per trade. So yeah, as I said, that is a base understanding, base concept. If you'd like me to cover the more advanced concept and how this all ties into an overall thing, then let me know in the comments and I'll try and make that video for you. As stated, I hope that's made sense. I hope you have enjoyed. If you have any questions about supply and demand zones, just put it in the comments or message me directly. With that being said, thank you for watching this video, and we'll see you the next time we have a Learn to Trade.